What's something people don't know about the aftermath of the Franco-Prussian War in 1871? It witnessed a period of unprecedented economic growth and optimism, particularly in Germany. The war had not only unified the German states under Prussian leadership, but also brought significant financial gains through the reparations imposed on France. This newfound wealth and unity set the stage for a transformative era in German history. The newly unified nation, flush with victory and hefty war reparations paid by France, embarked on an era of industrial expansion and financial speculation. Factories sprouted up across the landscape, and the Berlin Stock Exchange buzzed with activity as investors eagerly sought to capitalize on the booming economy. This period was characterized by a fervent belief in progress and the limitless potential of industrialization. This period, known as the Gründerzeit or Founders Era, was marked by a surge in railway construction, factory openings and the founding of numerous companies. The railways not only facilitated the movement of goods and people, but also symbolized the technological advancements of the time. Factories equipped with the latest machinery churned out products at an unprecedented rate, fueling further economic growth. Capital flowed freely as investors, both domestic and foreign, sought to capitalize on the seemingly limitless potential of the German economy. The Berlin Stock Exchange became a hub of financial activity, with investors from all over the world eager to participate in the economic boom. This influx of capital further accelerated industrial growth and innovation. The mood was euphoric, with many believing that a new age of prosperity had dawned. Public celebrations and gatherings reflected the widespread optimism, as people from all walks of life reveled in the nation's newfound success. The streets of Berlin were filled with jubilant crowds, confident that the future held endless possibilities. This economic boom was not confined to Germany. Across Europe and the United States, a similar spirit of progress and industrialization prevailed. Cities like London, Paris and New York experienced their own industrial revolutions, with factories and railways transforming urban landscapes and economies. Across Europe and the United States, a similar spirit of progress and industrialization prevailed. The Industrial Revolution brought about significant changes in society, as new technologies and innovations reshaped the way people lived and worked. Factories became the engines of economic growth, and cities expanded rapidly to accommodate the influx of workers. The Second Industrial Revolution was in full swing, with new technologies like the telephone, electric light, and internal combustion engine driving innovation and transforming industries. These inventions revolutionized communication, transportation, and daily life, making the world more interconnected and efficient. The telephone allowed for instant communication across long distances, while electric lights extended the workday and improved living conditions. Global trade expanded rapidly, fueled by steamships and transcontinental railroads, connecting distant markets and creating new opportunities for entrepreneurs and investors. The ability to transport goods quickly and efficiently across vast distances opened up new markets and facilitated the exchange of ideas and technologies. This interconnectedness laid the foundation for the modern global economy. The prevailing sentiment was that this upward trajectory would continue indefinitely, with progress and prosperity being the new normal. Business meetings were filled with optimism, and the general public believed that the advancements of the era would lead to an ever-improving quality of life. The sense of boundless potential was palpable, and many were convinced that the future held nothing but growth and success. However, beneath the surface of this economic euphoria, warning signs were beginning to emerge. Some investors started to notice inconsistencies and potential risks in the market. Subtle warnings appeared in the stock market, hinting at the possibility of an impending downturn. Despite the outward appearance of prosperity, there were underlying issues that threatened the stability of the economy. The rapid expansion of credit and investment was leading to over-speculation and unsustainable asset bubbles. Banks were eager to lend money and investors were equally eager to borrow, often without fully understanding the risks involved. This created a precarious situation where the value of assets was inflated beyond their true worth. setting the stage for a potential financial crisis. Companies were being formed and shares issued at a dizzying pace, often with little regard for their underlying value or profitability. The frenzy to capitalize on the booming economy led to the creation of numerous speculative ventures, many of which lacked a solid foundation. This reckless behavior contributed to the growing instability in the financial markets. Investors, blinded by the promise of quick riches, poured their savings into risky ventures, driving up prices and creating a climate of irrational exuberance. The allure of rapid wealth overshadowed the need for caution, and many people invested without fully understanding the potential consequences. This speculative bubble grew larger and more fragile with each passing day. This unchecked speculation set the stage for a dramatic and painful correction, which would soon reverberate across the globe. When the bubble finally burst, it triggered a wave of financial panic and economic downturn. Investors who had once been confident in their fortunes now faced significant losses, and the ripple effects of the crash were felt far and wide. The era of unbridled optimism came to an abrupt and sobering end, leaving a lasting impact on the global economy. The Gründerzeit was characterized by an almost insatiable appetite for investment, much of it fueled by speculation rather than sound economic fundamentals. This period, often referred to as the Founders' Epoch, saw a surge in entrepreneurial activity and a fervent belief in the limitless potential of industrial and economic expansion. Investors were driven by a mix of optimism and greed, often overlooking the inherent risks in their ventures. The influx of French war reparations into Germany had created a surplus of capital, which banks and investors were eager to deploy. This sudden availability of funds led to a frenzy of financial activity as both seasoned financiers and novice investors sought to capitalize on the newfound wealth. The banks, flush with cash, were more than willing to lend, often without stringent checks on the viability of the projects they were financing. This led to a proliferation of new banks, many of which were poorly capitalized and engaged in risky lending practices. These institutions, eager to grow quickly, often extended credit to speculative ventures with little regard for the potential consequences. The banking sector became a hotbed of competition, with each new bank trying to outdo the others in terms of the volume and boldness of their loans. Investors, eager to ride the wave of prosperity, poured money into new ventures, often with little due diligence or consideration for the long-term viability of these enterprises. The allure of quick profits overshadowed the need for careful analysis and prudent decision-making. Many investors were swept up in the euphoria of the times, believing that the economic boom would continue indefinitely. One of the most visible manifestations of this speculative mania was the railway boom. Railways were seen as the symbol of progress and a key driver of economic growth, and their construction attracted massive investment. The promise of connecting distant regions and facilitating trade and travel was irresistible to investors, who saw railways as a surefire way to generate substantial returns. Railways were seen as the symbol of progress and a key driver of economic growth, and their construction attracted massive investment. The promise of connecting distant regions and facilitating trade and travel was irresistible to investors, who saw railways as a surefire way to generate substantial returns. The enthusiasm for railway projects was so intense that even the most dubious proposals found willing backers. However, many of these railway projects were ill-conceived, with lines built in areas of low economic potential or parallel to existing routes. The rush to build railways led to a lack of strategic planning, resulting in redundant and unprofitable lines. Investors, blinded by the promise of progress, failed to consider the practicalities and long-term sustainability of these ventures. This overbuilding led to a glut of capacity and diminishing returns, eventually contributing to the financial instability of the era. The market became saturated with railway lines, many of which struggled to generate enough revenue to cover their costs. The initial excitement gave way to disappointment and financial strain as the reality of overinvestment set in. The overspeculation was not limited to railways. Investors also poured money into mining companies, factories and real estate, often driving prices far beyond their intrinsic value. The belief that these sectors would continue to grow unchecked led to a bubble that encompassed much of the economy. Investors also poured money into mining companies, factories and real estate, often driving prices far beyond their intrinsic value. The belief that these sectors would continue to grow unchecked led to a bubble that encompassed much of the economy. The speculative fever spread across various industries, creating an environment where rational investment decisions were overshadowed by the desire for quick gains. This speculative bubble was inflated by a lack of regulation and oversight in the financial markets. The absence of stringent regulatory frameworks allowed for unchecked speculation and risky financial behavior. Investors operated in a largely unregulated environment where the potential for fraud and manipulation was high. There were few mechanisms in place to protect investors from fraud or to ensure transparency in financial reporting. The lack of accountability and oversight created opportunities for unscrupulous individuals to exploit the system. Many investors were left vulnerable to deceptive practices and false promises. As a result, many companies were able to operate with little accountability, making exaggerated claims about their prospects and engaging in questionable accounting practices to inflate their reported profits. The lack of transparency and oversight allowed for the manipulation of financial statements, further fueling the speculative bubble. This climate of overconfidence and risk-taking created a ticking time bomb in the global financial system. The widespread belief in perpetual growth and the disregard for potential risks set the stage for an inevitable collapse. The financial system became increasingly fragile, with the potential for a crisis growing with each passing day. The bubble could not expand indefinitely, and it was only a matter of time before a trigger would set off a chain reaction of panic and collapse. The eventual bursting of the bubble led to widespread financial turmoil, with investors facing significant losses and the economy plunging into a deep recession. The era of overconfidence and risk-taking came to a dramatic and painful end, leaving a lasting impact on the financial landscape. The trigger for the Gründerkrach, the crash that would bring the era of prosperity to a shuddering halt, came from an unexpected source: Vienna. This city, known for its cultural and intellectual vibrancy, was also a burgeoning financial hub in the 19th century. The economic optimism of the time had led to a speculative frenzy, with investments pouring into various sectors, particularly the railways. On May 9, 1873, the Vienna Stock Exchange, at the time one of the largest and most active in Europe, experienced a sudden and dramatic collapse. The trading floor, usually bustling with activity, was thrown into chaos as prices plummeted and fortunes were lost in a matter of hours. The immediate cause was the failure of a prominent bank, Kreditanstalt für Handel und Gewerbe, which had invested heavily in speculative railway projects. These projects, while initially promising, had become overextended and unsustainable. The bank's inability to meet its obligations sent shockwaves through the financial community. The bank's collapse sparked a panic among investors, who rushed to sell their shares and withdraw their deposits. The atmosphere of fear and uncertainty was palpable as people scrambled to salvage what they could from the wreckage of their investments. The panic quickly spread to other banks and financial institutions in Vienna as depositors, fearing for their savings, lined up to withdraw their money. The sight of long queues outside banks became a common and distressing image, symbolizing the widespread loss of confidence in the financial system. Several banks were forced to suspend payments, and the Viennese financial system teetered on the brink of collapse. The suspension notices posted on bank doors were a stark reminder of the fragility of the economic boom that had preceded the crash. The Austrian government, caught off guard by the speed and severity of the crisis, scrambled to respond. Efforts were made to stabilize the situation, but the damage had been done. The Gründerkrach marked the end of an era of unbridled economic optimism and ushered in a period of financial caution and reform.